Hello everyone, welcome to our discussion sessions on official mock exam issued by ACCA for December 2025 exam attempt for Advanced Audit and Assurance Level exam. I'm your tutor Owais Mirchawala, and in our today's class, we will be looking at question number 2 of this exam. In the previous class, we covered question number 1 of this exam paper, a very detailed analysis in relation to it. My discussion sessions and my teaching techniques have always been useful for the students, and this is the reason why more than 70 of my students have secured nationwide positions in the exams I offer like ATX, AAA and SPL. And I've been teaching these exams for more than 15 years. Okay, so let's look at question number 2. It will be a very interesting discussion in our today's class. While we explore it, I want you all to listen to me carefully with patience and concentration. We'll be first reading the entire question, discussing the points which we have to include in the answer, and then we'll be actually drafting the whole answer, like developing the entire answer in the word processor document so that you can understand a detailed analysis of this exam paper. So let's deep dive into it. We'll be first reading the introduction screen in which the examiner gives you a brief introduction, that where you work, who is your client, and what the business activity is. Obviously, introduction screen don't tell you a lot about the question. These exhibits will tell, but it's the process which we'll be following, just like you will be doing in the examination, reading everything, thinking about the points, and then going in the detailed drafting of the answer. So let's start with it. It is 1st July 20x5. You are an audit manager at Crypto & Company, a firm of chartered certified accountants. You have recently been assigned to the audit of Luther Company, a listed entity and audit client of your firm for last 10 years. Its financial year ended on 31st March 20x5. The main business activity of Luther Company is the manufacture of farm machinery. See, when you are reading the introduction or any exhibit in the question, read it with patience, don't rush. It's not necessary that every line will mean certain meaning to you. Okay, obviously the examiner develops the scenario, like he first introduces you, that who you are, where you are working, about the client and all. As we move forward, you will get more relevant information. You are also assigned to the audit of Clark Company for the year ended 31st May 20x5. The audit is nearly complete and the auditor report is due to be issued next week. The following exhibits available on the left hand side of the screen provides information relevant to the question. This exhibit 1, Luther Company, provides details of an audit file note by the audit supervisor. And then exhibit 2, Clark Company, provides detail of audit completion matters which have been brought to your attention by the audit supervisor. So we'll be looking at each of the exhibit. The information should be used to answer the question requirement within the response option provided, which is a word processor, in which we'll be drafting all the points of the answer as we move forward. So let's read this first exhibit, exhibit number 1. Question number 1 of this mock exam was really easy. Let's look at question 2. I believe that this is also an easy one. The financial statements for the year ended 31st March 20x5 recognized revenue of $247 million. Previous year it was 242. Profit before income tax of 14.6 and assets of $535 million. Now, the audit engagement partner has asked you to review a file note prepared by the audit supervisor and to consider the matters to be reported in accordance with ISA 260, communication with those charged with governance, ISA 265, communicating deficiencies in internal controls to those charged with governance and management. If you remember, there is a complete technical article on the topic of communication with those charged with governance, and we have covered that technical article as part of our regular course because I have recorded detailed video lectures on each of the technical article. Like when we talk about communication with those charged with governance. So we need to communicate to those charged with governance, that is the audit committee, about all the matters which are relevant to the financial statement. Relevant to the financial statement, like any change in accounting policy, any wrong accounting treatment, we have to communicate it to those charged with governance. Any matter which is relevant for the audit activity, like anything which is impacting the audit opinion, any limitation imposed on us by the management. So we need to communicate it to those charged with governance. Okay, any weakness of controls. So all these things need to be communicated to those charged with governance, and we had a detailed discussion on it in the technical article section. So for this question, just a reminder, we report any accounting issues, any reporting issues, anything which is impacting the opinion, any weakness of the control, any bad attitude of the management. So anything which is relevant for the audit activity, relevant for the financial statement, we tell them to those charged with governance, that is the audit committee. That's the part. Like even before modification of the audit report, we first keep the audit committee in loop. So let's look at it. Inventory. Let's read. The company's draft statement of financial position for 20x5 includes an inventory balance of $150 million. In the current year, the company has chosen to adopt a policy of valuing its inventory using first in, first out method for the first time. See, now this is very basic accounting. You study it in knowledge module like in FA paper of ACCA. Changing this method from FIFO to FCO or FCO to FIFO, first in, first out or weighted average method, it's a change in accounting policy. And you have to apply it retrospectively. Like in the previous year also, you have to revise the financials. And this is reflected in the draft figures for 20x5. First of all, change in accounting policy has to be told to those charged with governance. And secondly, this need to be changed retrospectively like in the previous year also. So that the financials are like with like. The audit working paper identified that on review of the inventory record, 4 inventory categories with a total carrying amount of $7 million have not yet been remeasured and remain recorded on prior weighted average cost basis. See, this is a misstatement. This is a wrong treatment. They haven't applied FIFO completely in their current financials also. The important thing is that they have to restate the previous year accounts also. Because it's a change in accounting policy, you have to make a comparison like in the previous year FS, which will be like whenever you look at the FS, current year and last year. So the policies need to be consistent. So this need to be communicated to those charged with governance that, okay, it's a change in accounting policy. They are moving to new accounting policy of first in, first out, number one. And it has to be adjusted retrospectively. Number two, they haven't adjusted the complete categories in current year also. It's a misstatement. It's a misstatement. And this side of $7 million, if you look at your profit before income tax of 14.6, so 7 million divided by 14.6, it's like 47% of your profit. So obviously it's a material issue which need to be communicated with those charged with governance. Okay. Then something in relation to warranty provision also. In respect of the company's long-term product warranty provision, an independent valuation firm with specialist knowledge and experience provided estimates of the warranty liability at 31st March 20x5. The liability was materially less than prior year because of change in assumptions. The reason for those changes were not included in the valuation report. Again, it's wrong. If the assumptions have been changed, they need to be explained. And Luther Company Finance Director explained to the engagement partner that as the valuation firm was experienced, they did not feel the need to ask for further details. What a wonderful argument. This means that whenever I'm dealing with any experienced guy, we just rely on them. The answer is no. Okay. The audit team concluded that the specialist methodology and resulting estimates were reasonable. But still, it needs to be communicated to those charged with governance that expert has not provided the reasoning and the finance director is also not fulfilling his responsibility of questioning him. Okay, it is the responsibility of the finance director also. That indicates that finance director lack expertise. That professional skepticism is a basic skill expected from a profession. So we need to communicate all of these things to those charged with governance. Sometimes issues relating to financial, issues relating to audit, and issues relating to deficiencies in controls and systems. Okay. So we will be looking at all of these things when we will be actually drafting the answer. Availability of information and manual journals. The information provided by Luther Company Finance Director at the start of the final audit did not support a number of material balances in the draft financial. As a result, a number of requests for additional information had to be made, which prolonged the duration of the audit. It's a weak control. That why the data is not matching. Like the financials are made by the finance director team, ledgers are maintained by them, so why they are not matching? And obviously it is delaying the audit activity, so it's the hurdle which we face during audit, so we need to tell it to those charged with governance. Even when additional information had been provided, the audit team found it difficult to agree the draft financials to the trial balance and general ledger because several manual entries were made. Significant additional audit testing was undertaken as a result. Similar problems in confirming manual journals were noted in the previous year and were discussed with the audit committee. See, manual entries show that they are not following their regular systems. Like why we need to do manual entries when we have a system to record a sale, we have a system to record depreciation, we have a system to record purchase of asset. Manual entry means that direct double entries are being recorded. So weakness of control, okay, balance is not matching, prolonging the audit activity. This all is communicated to those charged with governance, the audit committee. Okay. Now someone must be thinking that, sir, how do I know that what I have to communicate? Wait a minute, I have taught you the complete technical article. And even if you don't remember it, listen to me. Whatever which is relevant to the financial statement, relevant to the audit activity, impacting any opinion, impacting controls, any hurdle faced, you communicate it to those charged with governance. Because they are responsible, they are authorized by the shareholders to ensure that good governance practices are followed in the company. Then engagement partner. You are aware that your firm had intended to replace the current engagement partner, Legs Green, with Louis Khan, who is Crypto and Company other specialist in the industry. Unfortunately, Louis was taken ill earlier this year and will now not be available until the next year audit. As a result, 20x5 is the 8th consecutive year in which Legs Green has acted as an engagement partner. You know that 7 years is the maximum permitted limit for a partner to work on a client. Additional 1 year, this 8th year can only be done with the permission of the audit committee. So obviously this need to be communicated with those charged with governance and it need to be notified them that okay, threat to independence exists, but due to uncontrollable situation, this is happening because the new partner has got ill. Okay. And then comes procurement procedures. During the testing of trade payables, it was found that approved supplier list is not maintained. Invoices received are not always matched back to the goods received. This was mentioned to the procurement manager who said that the suppliers are switched often depending on which supplier is cheapest. So it would be difficult to maintain an up-to-date approved supplier list. Again, it's a weakness of control. The approved suppliers are those for whom you have done a due diligence. You know that, okay, they are valid suppliers, they can send goods on time. Okay, you have agreements with them. So you need to maintain an approved supplier list. It reduces the risk of fraud and error because a new supplier cannot come in like in an unknown manner. And similarly, if they are not matching the goods with good receipt note, it's a major weakness because maybe you are getting lesser goods and you are paying for the complete invoice. So if you look at it, I believe that the points are just standing in front of you. Recommend the matters to be included in your report to those charged with governance. Any financial reporting issue, any matter relevant to the audit, any weakness in the control, any problems you face during the audit activity, you tell all of them to those charged with governance. And we have studied this complete article. Believe me, a very easy 13 marks requirement, very easy. Like I would say, it would be a blessing if someone is getting a question like this. Okay, Just look at it while I draft it. Believe me, it will be very easy. Okay. So we are crypto and company. Our firm is crypto and company, and this is the first requirement which we are doing. I've just copied and pasted the requirement. Okay. Since it's question number 2 and 3, there are no professional skill marks of communication. There are professional skill marks, but no marks of communication. So no need to make any format. Here the skills are of analysis, evaluation, acumen, and skepticism and judgment. Like how well you analyze the data, analyze the rules, evaluate related to the scenario. Commercial acumen mean your practical insight. Okay, like in question number 1, when you talk about businesses, that's commercial acumen. Okay. In question 2, 3 also, your commercial acumen can be demonstrated in a lot of issues where you comment on something which is not good for the firm, or maybe which is not good for the long-term continuity of the client. Like for example, they are not matching the goods received with the purchase order, so maybe they are paying extra. So that is something harming their business also. Skepticism, questioning things, judgment, ability to take a decision that what is right and what is wrong. So 13 marks, obviously while writing it, we will demonstrate our professional skill. But believe me, a very easy and interesting requirement. Recommend the matters to be included in your report to those charged with governance of Luther Company. Auditor has to report all matters which are relevant to the audit activity, relevant to the financial statements, any weaknesses in controls, any difficulties faced during audit activity, any matter impacting audit opinion or audit report to those charged with governance as part of audit activity. See, it is the responsibility of the auditor. Even you know that whatever audit plan you make, you discuss that audit plan also with those charged with governance. Because those charged with governance is not management, they are the non-executive directors. Just like auditor is concerned to bring the true and fair view to the shareholders, these audit committee and those charged with governance are also responsible. So auditor has to report all matters which are relevant to audit activity, relevant to the financials, weaknesses in the controls, difficulties during audit activity, anything which he thinks that, okay, the audit committee need to know, okay, need to be alerted to them. So he will communicate that. So now if I talk about first I gave the intro. Now if I talk about the inventory thing, change in accounting policy, okay, change in accounting policy from weighted average method to first in first out method is or need to be communicated to those charged with governance, as it will affect overall valuation of inventory, of closing stock. This change in accounting policy has to be applied retrospectively, and comparative financial statements also need to be adjusted to show a like with like comparison. So if you just understand that what we tell to those charged with governance, because I got very disappointed when one student messaged me that, sir, in the mock exam, there's a requirement that what we need to communicate to those charged with governance, and I don't know that. So I got really disappointed that, okay, I have uploaded 25 lectures almost on technical articles, like 1 hour lectures, and these guys don't listen to the lectures. And when they ask such a question, it's like very bad thing for the teacher, because when we have done so much effort to teach you, so you have to watch the lectures. And this is an important part of the course. What we need to communicate to those charged with governance. any matter which is relevant to audit activity, relevant to the FS, weakness in control, difficulties you faced in audit activity. So this is a financial reporting matter, that change in accounting policy. Okay. Now, another thing which you need to communicate to them, if you look at it, that 4 of the inventory heads have not been shifted to new method. So that's a misstatement. Okay. Failure of management to shift 4 heads of inventory to new valuation method is a misstatement in financial statement, and it may impact auditor's opinion. Whatever policy for inventory valuation is to be adopted, that has to be applied to all inventory heads. Like you can't do that, okay, few items are at FIFO, weighted average, and few are at FIFO. Okay. So that's a misstatement. Okay. 4 heads of inventory which are not valued at first in, first out, despite of adoption of this policy, represent $7 million, which is how much, if you remember, I think 4 categories were not adjusted. So their value is $7 million and your profit before income tax is 14.6. So that's 47%. Represents 4 heads of inventory which are not valued at FIFO despite of adoption of this policy, represents $7 million, which is 47.9% of profit before income tax. It is a misstatement related to material head to financial statement. Okay, it's obviously material. So, what we communicate to those charged with governance normally, then one change in policy, management's mistake, comment on its materiality. So this is what we tell to those charged with governance. Then in relation to warranty provision, changes in key assumptions which resulted in significant fall in the warranty provision and lack of reasoning given by the expert. So if the expert is not giving the reasoning, why are we paying it? Maybe we hire some new kid and he just try, okay, this is the new provision. Okay, so reduction in warranty provision significantly, and failure of expert to provide reasoning of change in assumptions, show weak controls at the client Luther company, as such report should not have been accepted. Okay, finance director also failed to ask for it and instead gave a reasoning that expert is professional in his work and no need of reasoning is required. This shows lack of skepticism, or I would say professional skepticism, in finance director. Okay. Additionally, significant, or I would say reasoning of significant changes in heads of financial statement should be known by those charged with governance. Okay, auditor should communicate lack of reasoning given by expert, and then also communicate their reasons of considering them as valid, or I would say as reasonable assumptions. First of all, we'll tell that, see, expert has not provided the reasoning, but we have done our audit work on the basis of which we believe that the estimates are reasonable. But still, that need to be known by those charged with governance. See, what we tell them in relation to change in policy, we said that, okay, there is a misstatement. We commented on materiality. We commented on behavior of the finance director and weak systems, that why we don't ask people when we are paying them. And reasoning of significant changes in heads of FS should be known by TCWG. Auditor should communicate lack of reasoning by expert and then also communicate their reasons of considering them as reasonable assumptions. Like what work they did. See, some students simply don't understand the role of those charged with governance. They say, okay, we have to hide from those charged with governance. No, those charged with governance are on your side. They're not the executive directors, they are NEDs. They are on the side of the auditor. We and TCWG have to work together to ensure that the things are in true and fair way. Because when there will be anything wrong, the shareholder will catch the auditor and you will also catch those charged with governance. That what were you guys doing? Why you failed to identify the issues? Okay. Then, if I move forward about the manual journals, first of all, the balances not matching between the FS and the numbers appearing in the accounts. The information provided by the finance director at the start of final audit did not support a number of material balances in the draft FS. So the ledger balances and FS not matching. So that's a weakness of control. Secondly, we need to spend a lot of time in verifying things. And recording manual journals is not a right behavior. Okay. Initial information provided by finance director failed to match with account balances in Luther Company. Initial information provided by finance director failed to match with account balances in Luther Company draft financial statements. Okay, this shows weakness of systems, that transactions are not recorded properly and draft financial statement do not match with ledger balances and accounting records. See, like a rational mind cannot accept this. Double entry, T account or a ledger, trial balance, income statement, SOP. It's the same process. But income statement and SOP don't match with trial balance. So what are you guys doing? You have weak controls, you have weak processes. Okay? Why manual journals are being recorded? Okay? Greater audit time spent due to inconsistent records also need to be notified to TCWG, as auditor has to communicate difficulties faced during audit to them, to TCWG. We have to do it. It is a difficulty which we faced. Okay. Improvement in process and controls need to be done to avoid such issues in future. Then these one mark point, small points, don't write too much. Practice of recording manual journals in accounting records is not a right practice. Transactions should be recorded with proper systems rather than manual journal entries to adjust the accounting balances, to adjust the balances. This may lead to risk of error and frauds. Okay. It also need to be notified to TCWG that this matter was also raised last year. Okay, because it is their responsibility that whatever we raise to them, they get it sorted before the next year audit. So maybe TCWG is also sleeping. So if you look at it, 1, 2, 3, 4, 5, 6, 7, 8, and 9. See, I believe that it's one of the easiest requirement because all the failures were presented by the examiner in a golden plate. You just have to pick it and write it. Like if someone is recording a manual journal, it's very much logical that it's not the right practice. The balance is not matching. It's the weakness of control and system. The auditor has to spend greater time. It's the difficulty which we face during the audit activity. Then the engagement partner thing. The same partner will be working for the 8th year. Okay. Now, Lex Green will be doing Luther Company audit for the 8th year, for the 8th consecutive year in 20x5. It is a significant ethical issue as long association creates familiarity threat. Okay, maximum duration permitted is 7 years for engagement partner. However, additional 1 year can be allowed in exceptional circumstances if permitted through audit committee. Through audit committee, it needs to be notified and approved through TCWG, which is also the audit committee. That same partner will be working for 8th year due to unknown circumstance of new partner getting ill. Okay. See, we need to communicate all of this to those charged with governance. Okay. And here we need to take their permission also because it's the 8th year. 8th year is only permitted through the permission. Then there is no approved supplier list being maintained. So there is a risk that some unauthorized suppliers may be given the work. Risk of fraud and error exists. Okay. Lack of approved supplier list at procurement department of Luther Company is also a control weakness as it exposes to a risk of fraud if work is or if order is given to a supplier without sufficient due diligence. It may also affect product quality of Luther Company if new supplier is not supplying quality goods. Okay, that's why we have a list of approved supplier. We check their quality, we check their ability to do the business in a proper way. Lack of control, or I would say lastly, lack of control to manage or to match the goods received back to GRN. That's the big thing. Invoices received are not matched to goods received note. Okay. Lastly, lack of control, or I would say lack of practice to match invoices with goods received note is also a significant control weakness, as it may result in overstated invoices getting paid, invoices getting paid, some invoices against which goods are not received, or lesser goods are received may get paid. Okay, this is a control weakness. So what do we communicate to those charged with governance? anything relevant to audit, anything relevant to the financial statement, any weakness of control, anything which is affecting the opinion or the audit report, we communicate all of these things to those charged with governance. Like, I believe it's an easy thing. Okay, like we have to communicate all of these matters to those charged with governance. So, like a change in accounting policy, any misstatement in the financials, okay, uh, material issue. Okay, so one mark for each comment. Change in warranty provision, no reasoning. Okay, then the account balance is not maintaining. Like, how is it possible that my draft FS is not matching with my account balances? So this clearly means that the systems are not working as expected. Any difficulties in audit activity, manual journals, familiarity risk, we need their approval for the 8th-year audit, lack of approved supplier list, not matching the invoices with GRN. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, and 11, 12, 13. A 13 marks requirement and 13 comments, believe me, like there wasn't a single point on which I have to think or I have to worry that, oh, it's difficult. It was like the points were standing in front of me and I just have to push them. Okay, go inside the answer, go inside. So easy question. Yeah, the important thing was that a student should know that what they have to communicate to those charged with governance. If someone don't know that, if someone has not covered that technical article, obviously that was a problem. So now let's look at part B. I believe it is also that much easy because question 1 was very easy and question 2 part A was also very easy. So let's look at question 2 part B. Okay. So I want you all to listen to me carefully. So let's read exhibit number 2 and then draft its answer. It's just a 7 marks requirement. Okay, so now we are reading this exhibit. Clark Company is an unlisted family-owned business which specializes in the service and repair of both commercial and privately owned motor vehicle. The draft financial statement recognized profit before income tax for $4 million and total assets of $41 million. Let's see. In March 2005, the Clark Company was found liable for environmental contamination at a former workshop site after hazardous chemical leaked into the groundwater. The Environmental Protection Agency issued a cleanup order requiring Clark Company to pay $1 million for remediation work, which remained unpaid at 31st May 20X5. The audit working paper include a copy of verified letter dated 25th May 20X5 from insurance company confirming that the environmental liability claim is fully covered under Clark Company's comprehensive business insurance policy. On the basis that the company has no net liability as a result of the environmental claim, the finance director has not recognized any amount in the financial statement and has not made any disclosure in relation to this matter. See, this is a wrong accounting treatment. You cannot set off. Payable is to the environmental body, receivable is from the insurance company. Okay, when we have got an order, we have to record a liability, and if the insurance company has given us the confirmation, we can record a receivable. Okay, but we cannot net it off, and we also need to give disclosure in relation to this matter. So, not disclosing it in the financial statement is not the right approach. And then a claim of $1 million is obviously material to the financial statements. Okay, so let's see what he's asking from us. Evaluate the matters to be discussed with the management in relation to the legal claim and justify an audit opinion, explaining the impact on the audit report if the misstatement remains uncorrected. So it's a simple accounting issue on which you have to develop the discussion and then talk about the impacted audit opinion. Okay, so if we look at it, I would say it's just a very routine requirement and a very easy accounting issue. Okay, first of all, you will comment on the materiality of the issue. That $1 million is obviously material from the perspective of profit before income tax also, and from the perspective of assets also, it's 2.4%. So it's material to the financial statement. Then as per IS 37, a liability has to be recorded since the cleanup order has been issued. So we have a present obligation. The outflow is obviously probable because the order has been issued, and reliably estimate can also be done. For the receivable from the insurance company, it should also be recognized since it's virtually certain and insurance company has given us the confirmation. But net off, setting it off is not allowed. That's wrong thing. You have to recognize asset and liability separately. Disclosure should also be given. And obviously, it's a material but not a pervasive issue because 2.4% won't make it pervasive to the financial statement. So the audit opinion will be shifted to qualified audit opinion if the management fails to do the required adjustment. Okay. So matters to be discussed along with the audit opinion. It's just a very routine requirement. You will talk about the materiality, the correct treatment, comment on the management, heads affected, and all of the things. Very simple. Okay. So, claim of environmental body against this, what's the name, Clark Company, against Clark Company of $1 million represents 25% of profit before income tax and 2.4% of its asset. Therefore, it is material to financial statement. First of all, you always talk about materiality, a very simple statement. Obviously, $1 million is 25% of 4 million, and of assets, it's 2.4%. Okay, now, first of all, we need to record a liability of the cleanup order issued against us. Okay, because obviously, when we have got an order, we have to pay it, so a liability exists. Okay. Order issued by environmental agency to pay $1 million for remedial cost creates present obligation on Clark Company. Additionally, chances of outflow are also virtually certain as order has been issued, and reliable estimate of amount also exists in terms of $1 million obligation. An expense along with related liability need to be recognized. See, IS 37 treatment. Additionally, receivable from insurance company should also be recognized as insurance company has given confirmation that this claim is covered under the insurance policy. Okay, a separate insurance company receivable, insurance receivable, and income should be recognized as chances of inflow are virtually certain. Okay, it is to note that payable to environmental body, agency, and receivable from insurance company cannot be set off with each other, as these are two separate receivable and payable to be settled. Okay, no legal right exists of net settlement because obviously the parties are different. Okay, so issued a cleanup order requiring the Clark Company to pay $1 million for remediation work. Okay, and obviously the receivable from insurance company is a separate receivable. Now, finance director's failure to recognize receivable of insurance company and payable for remediation work will misstate financial statements. Okay, net impact on income statement will be zero of this adjustment Because in income statement, obviously, the income and expense will net it off. Of this adjustment will be zero. However, net impact on income statement will be zero of this adjustment. However, in SOFP, assets and liabilities will be understated by $1 million each, because you have to record a separate receivable and a separate payable. Additionally, a disclosure note is also required for this matter in financial statement, explaining the issue and the remediation cost payable by Clark Company. However, its coverage under insurance should also be stated. Failure to give disclosure note will misstate notes to the financial statement component of FS. See, a very major issue. Students consider income statement as part of SOFP, of FS. They consider SOFP as part of FS, but they don't think that notes to the accounts are part of FS. You know, there are 5 components of financial statement: income statement, statement of financial position, cash flow, changes in equity, and notes to the accounts. So failure to give disclosure is also wrong. Just look at my approach. Small 1 mark point. Materiality. Record a liability as per IAS 37. Record a receivable. Net of not allowed. Wrong treatment done by finance director. Failure to give disclosure. So how many marks are done? 3, 4, 5, and 6. It was a total 7 marks requirement. One last comment. Misstatement in relation to issue of $1 million is material but not pervasive to financial statement. See, pervasive means which has a spreading effect, which misstate or make the financial statement meaningless as a whole. Like 2.4% of asset is obviously material but not pervasive. Is material but not pervasive to financial statement as it represents 2.4% of asset. Auditor will express qualified audit opinion if management fails to do required adjustment. It will be stated that financial statements as a whole represent true and fair view except for misstatement in relation to order issued by environmental agency. Misstatement will be further explained in basis of qualified opinion paragraph. See, if someone says that this pre-mock is difficult, I seriously need to meet it, and then I need to beat it. Like, what a lovely question. It's just a very routine requirement which he asked. Materiality, liability thing, receivable thing, net of not allowed, comment on the management, disclosure note, and the opinion. Still, I can add 2-3 more points, like the heading of the opinion paragraph will change because we have to talk about impact on report also. I can add heading of the opinion paragraph will change, heading of basis of qualified opinion paragraph will change. You can add those comments also. So if I look at this question, it's done. Okay. So first part was in relation to those charged with governance, very easy one. And then this second part was in relation to a legal claim for which the order has been issued against us. So we need to record a liability, and along with that, we need to record a relevant receivable also, because the insurance has approved the claim. So I hope that you guys are understanding it. We did question 1 in the previous class, and now we discussed question number 2. If you have any query, you can always connect with me directly on my WhatsApp number. These past paper discussion sessions are really important for your exam preparation. And as you know that in my course, I have discussed more than 10 complete attempt exam papers. So if you really want to increase your chances to pass the exam, cover them. Okay. And you can always contact me directly on my WhatsApp. Thank you, everyone.